Hello everyone and welcome to our weekly our weekly educational webinar, excuse me, from ICM.com. I can see some hands up if anyone has any question before we start, so please write it down or else we can start immediately. Okay, perfect. So today we chose to talk about the top trading strategies that or popular trading strategies used by traders. And definitely we know that the market moves in either trends or in trade in a certain range. So we have two types of markets: trending markets and ranging markets. And also traders would have to choose a strategy for each type of market. So a strategy that works for in trends, it won't work when the market is going sideways, and vice versa. So that's why we always make sure to uh, to to to, uh, to inform the investors or increase their knowledge about the types of markets, so they can understand how the market moves, and based on these market movements they would be able to set their trading strategies and set their targets. So first we're going to start with talking about the range trading strategies, what are they, and the trend trading strategies. And after that, my colleague Sai will conclude the webinar by talking about the pillars of a successful trading strategy. So first, let's move on with the stating what are range trading strategies. A trader would have to detect a certain range. This range could be the boundaries of this range could be the overbought and oversold areas that could be detected or probably detected with the help of an oscillator. We talked previously in certain webinars about different variety of indicators and oscillators that would help us to detect overbought and oversold areas. An overbought area, in this case, an overbought area would be similar to a resistance. We know what's a support and resistance. A resistance is a place where the selling pressure or the selling orders available would offset the buying power and drive the prices lower. So usually a trader who is looking for a reversion to the mean or for the resistance to hold, he would be initiating a sell position, and vice versa. An oversold area would be a support area where the buying power or buying orders should overcome the selling power and take the price higher, and therefore a trader would be looking for a buy position if they are looking for this range to hold. These strategies would work out well. You would perform better if you are using these strategies when the market is moving up and down, definitely, and not trending. When the market is trending or setting a significant long-term trend or medium-term trend, maybe you will suffer with your strategies if you don't have a proper exit scenario for your trades. So this is what does a range trading strategy mean. One of the key strategies used by traders is that we can go for the the zigzag indicator. I'm gonna show it in a while on the MetaTrader 4 platform. Or we can manually detect just the previous two tops and the previous two bottoms. We draw horizontal lines on these tops and bottoms, and therefore there we have two areas, an area above the price and one below the price. So what we are trying to say is that when we detect these two areas, we are believing that the price won't move above them, above the upper area, and won't move below the lower area. So the price will continue to trade within this certain range. Also, a trader could add an oscillator, such as the relative strength index, stochastic oscillator, or commodity channel index, or any other oscillator that could help him verify whether these two areas are matching with the overbought and oversold territories of these oscillators. Also, Bollinger Bands, instead of setting horizontal lines to detect these areas, you can use price bands. Price bands, we had also a webinar talking about the four types of price bands, about the Donchian channel, about a Keltner channel, envelopes, moving average envelopes, and the Bollinger Band. So among to top indicators that could be used, the Bollinger Band and envelopes, moving average envelopes, can help you detect a certain range and create trading signals for you. So what we have to make sure before going to the technical part, or to our technical analysis and take decisions based on the chart, what we usually recommend for traders is to make sure they don't only rely on technical analysis in trading. They have to merge fundamental and technical analysis. So when the market is not pricing in a certain change, or the price is not changing based on certain fundamentals, so you can't just go uh, for a range trading strategy, since at a time, if the market is mispricing the value of an asset or a financial instrument, by the time it will reprice its value. And usually when this happens, we witness trends in the market similar to what is happening currently. The changes in the recent monetary policy the recent changes in monetary policies from top central banks led to a narrowing difference between the monetary policy from, for example, from the Federal Reserve and the European Central Bank. So this closed gap between the two policies affected the market, and now the euro dollar, for example, is pricing what happened a while ago, or what is happening in the bond market, for example. So that's why we always have to make sure that we don't go, for example, to adopt a range trading strategy when we believe that the fundamentals are hinting that the market could be trending, since there are some assets or asset classes that are mispriced in the market. So always make sure to do your fundamental analysis. Make sure you've done your homework properly by reading the different economic indicators, by combining the results of economic indicators and their effect on the monetary policy decision of the top central banks, and what would their impact be on the policy, whether it will remain the bank will adopt further easing stance or tightening stance. So this will have definitely an impact on the market. When you are able to detect whether the market has certain catalysts or not, it will help you whether to choose a range trading strategy or a trend trading strategy. When you believe that the current market fundamentals are hinting that there will be a shift in the market, therefore you would be going or choosing a trend trading strategy. When you believe the market is lacking fundamental catalysts or fundamental drivers, you would be choosing range trading strategies. And I'm going to show you the difference by just looking, but before jumping to those, I'm just going to explain this on the oil chart. So this is the WTI chart. Back then, if we go for the daily chart, we're just going to add the Bollinger Band for a certain explanation. If you can look here, back then when we had certain drivers in the market, here we had the American airstrike back in the Gulf, and then there was a response, and then the market was here pricing in the collapse between the talks of the collapse and talks between top oil producers, and then the market went down, and here then they agreed on further output cuts, and the market then rallied back higher. And here, when the market lacked fundamental drivers, so we witness how the price range, the market traded inside a tight range, and this range was getting closer and closer. So the bands were getting narrower to each other, until in the past 3 days we witnessed like productive talks on further bets, further fiscal bet stimulus from the United States. And this also, there are some other bets on more monetary policy stimulus from top central banks due to the continuous outbreak of the coronavirus around in top countries around the world. So this also had some changes on the market, and we witnessed a breakout from the range that we've been trading in for the past 2 months almost. So that's a very clear chart on why you have to make sure that you do your fundamental analysis before choosing whether you want to trade a range or the trend. Here, when we had market drivers, we had a clear market drivers. The market was moving in a trend. So if you were using a range trading strategy here, you would have lost a lot of money. But if you were using a trend trading strategy, you would have made a lot of money. And here it is almost the opposite. So if you were betting on buying the highs or selling the lows here, you ended up with your stop loss triggered. But here, if you were selling the overbought area and buying the oversold area, you would have made money for the past 2 months. So if we do a past performance, a strategy test for the past 8 months, we can see that a range trading strategy would have made you a little bit of a return in the past 2 months, while being a total failure in the previous 6 months from January till early June. While if you were using a trend trading strategy, you would have made money from January until June 2020. So here, definitely, we can just have it's very simple. By just using a moving average here, you would have made money. This is a short signal, and then you got stopped out here, and then again another short signal, and you got stopped out here. Another short signal got stopped out here, and then here the market reversed, and it was on the upside. And even if you bought the break above the trend line here, your stop was almost equal, so it was almost a break even or a slight loss relative to a sharp drop or a sharp return in the market. So that's why you always have to make sure you covered your fundamental analysis before setting whether you are going to trade the range or you are going to catch the trend. So this is a key point that we have to clear. What are the key risks for a trading strategy, a range trading strategy? Definitely, number one is a breakout. If the price is breaking out from the range that you did set, reversal if the market is reversing ahead of reaching the overbought territory or the upper area that you chose, and an expansion if the market exceeds the upper area but then it goes down. So and the last one can be avoided if you have a recovery exit, which means you aren't relying on a certain stop loss, but you are having a certain recovery strategy, which has to deal with your losing trades. So this could help you in this term. And the first one, breakout, definitely if you have a solid stop loss, it would be the best approach to deal with the first risk. So this is what you need to know about the range trading strategies. I'm going to cover also the basics of the trend trading strategies before moving to the MetaTrader 4 and show you some of the trading strategy, the trend trading and the range trading strategies. So the vice versa for trend trading strategies, a trader would use a technical indicator to detect the trend. We have to detect whether the market is moving up or down, and also he has to use some oscillators to show that there is a momentum in the current trend, that the market is able to move upwards or able to move downwards and not go inside a range. So these are key elements of going with a trend trading strategy. A trader can buy the new highs in an uptrend. So we know, for example, we know, for example, that this the trend could look like this. We have certain waves up and corrective waves down. So if the market was moving up and then it went lower, so a trader would set a buy stop here, for example, and the market went up, and also here it is the same. So a trader can buy a new high in the market and the market would move higher, or a trader would have to wait for a retracement. A retracement here, for example, the market is going into a correction. Maybe they can use a Fibonacci retracement the tool, so they can detect proper retracement levels, and maybe they can buy here or here or here. So it depends on the method that they are using in order to choose the retracements in order to join this trend. But definitely when you are buying this bottom, you have to make sure you abide by your risk management techniques, since this could turn out to be that the market is moving down and maybe we are having a new trend lower. So you don't want to be stuck inside in buying positions at the beginning of a downtrend. So this is what you need to know in terms of basics. What is most important also for trend trading strategies, we have a couple of indicators that most of the traders use when using trend trading strategies. The moving average, which smooths the price action and makes it easier for us to have a look at what's happening in the market. We have also the moving average convergence divergence, which we talked about, which shows us the correlation between two or the movement between two set of moving averages. One of them is the subtraction of two moving averages, and the other one is a moving average for the final result of the first calculation. We have also the relative strength index, which can show us momentum of the current trend and whether there are possibilities for the market to move higher. I'm going to explain this also how. And also we have the unbalanced volume, which also shows us the cumulative buying and selling in the market. And we have the Donchian channel, which would highlight the recent highs and the recent lows within a certain period chosen. So these are the key indicators used in trend trading strategies. Now we're going to move to the MetaTrader 4 platform in order to talk about some of the easy strategies to use. So let's go for the H4 chart. Okay. So let's start first with what we were mentioning earlier, that we have to go for. We can use, for example, the zigzag indicator, and it will show us a certain. I'm just gonna thicken. Okay, so for example here, a trader would be setting these. Would be looking for the recent lows in the market or the recent highs. So a trader would have to detect the recent highs and the recent lows. So if the market is getting closer to this area, a trader would have to buy again. So here the market on the upside, the market entered inside this range. So a trader would start initiating sell positions here. We witnessed the first reversal, a bigger reversal, another reversal, and now here we had a little bit of an expansion. So he has to adjust the trading levels for the upside. On the downside, we didn't witness a rally lower, so a trader would have to also adjust to keep on adjusting the bottoms. If the market didn't reach a certain level, he shouldn't be jumping into trades before a certain drop to a certain range. Also, if a trader is more aggressive on the market, they wouldn't wait for two tops and bottoms. They would do, for example with what happened here on the previous top or the previous bottom. They would say that the market is gonna at least hold for one time and reverse. So a trader would be selling here and buying here at a time. So this could be beneficial. And also, similar to what happened here, a trader would be waiting for any retracement here again, and we witnessed this retracement, and the market went from almost $40 68 cents a barrel towards 38 and 40, which is almost around $2. So this is one of the easiest ways in order to detect tops and bottom. We can go more conservative if we just change the depth of the zigzag. So here we skipped the smaller ones. So we can set, for example, here we can set a certain high, and then definitely we need to put a certain stop. For example, if we were selling here, we had to put a margin for the upside and the margin for the downside. For example, 0.5% or 1% to the upside and 1% to the downside. So by doing that, we can detect an upper area and a lower area where we could be initiating trading signals. Also, if we go for, I talked about choosing the Bollinger Band or any of the envelopes or any of the bands. Also, if we can use here the Bollinger Band with the default settings, we're using a 20 simple moving average and 2 deviation. So this would also give us couple of trades. A trader looking for a reversion to the mean or a range trading would be looking to sell any trade above the upper band or any trade above the lower band. And here you can see some reversals back to the 20 simple moving average. But definitely you have to make sure to set a proper exit for your trades. So either you have to put a solid stop, or you have to go for example, small positioning at the beginning. So you have to build a position. What if the market, for example, you started buying here and the market continued to go lower? So you have to make sure that here it was a small entry, and then you add to your position if you believe that the market is going to continue trading inside the total range. But at the end, you have to definitely set a stop to exit a trade and not being caught in a buying trade if the market goes back lower. For example, if a trader was buying a couple of positions, the first position here, and then another bigger position here, another bigger position here, and a bigger position here. So when the market reversed, he made a lot of money, but also he has to make sure to being safe from the fact when if the market continued to move lower here, he won't get his account busted. So he needs to make sure to set at least an equity stop loss or a certain stop loss based on a certain level. So maybe they would have chosen to set a stop loss here, but also they would have to make sure to have a proper entry in inside all these levels here. So we were talking about almost 30% to drop in oil prices from 36 towards almost 28, so 30 is almost around 20%. So we have to make sure to align or how to manage our entry volume in order to sustain this drop in the market if we are looking to hold any reversal or any knife dropping. But definitely this is not the best way to trade, and it's better to avoid such hassle. So this is for a range trading strategy. Also, we can go for the easier ones. We can definitely use any of the oscillators. We can go for the RSI, for example, and we can trade the extremes of the RSI. So if the market is going up here, we initiate a sell position, and the market dipped below 30, we initiate a buy position. So and inside the ranging market, you would have very good entries in the market versus, of course, the risks of any breakout, similar to what could be happening here. So let's take a live example here. So if I'm looking for reversal or the market is going to trade inside the range, so I would set a level here near 42.57. I would take, for example, 1 to 2% to the upside or 1 to 2% to the downside. And if the market exceeded here and the RSI is trading above 75, so definitely I have to relook at my decision, and maybe I should respect my risk management, either to take a loss and exit the market and just look for another entry, or I have to start dealing with my losing trade in a proper way in order to get out with the least losses. So this is one of the easiest ways in order to train the range, to trade inside the range. We have now. Let's move to the trend trading strategies, which are much easier to choose. But definitely the first tool that you have to set is a moving average. You have to make sure that the market, for example, is trading above a certain trend, and after that you can use other indicators in order to join. So what I talked about a while ago is that you can look for buying, if you believe that the market's going to trend, you look for buying new highs. So this, for example, you set a buy stop here and the market here moved higher, another buy stop here and the market moved higher, another buy stop here, and also the market moved higher, another buy stop here, the market moved higher, and the buy stop here, the market got exhausted. But definitely also here you got some points. If you have another buy stop here, the market triggered your buy stop at this area. So this is one of the easiest ways into trading a trend. You just buy the new high in the market. Also, there is another approach which could be much rewarding, but also less risky. If you can wait for retracements in the market, and you can buy these retracements here, for example, any place here, any place here, any place in these retracements. So you are buying the bounce backs in the markets, or buying the dips in the market, as we call it, and the market is rewarding since it is a trending market. The market moved from almost $23 a barrel towards 43 today. So we're talking about $20 a change, despite the fact that the market narrowed here in terms of range. It continued to move to the upside. So all these buy dips trades were rewarding. So this is one of the ways that you can use in trading. There is another one which could be, for example, by using the parabolic SAR. So you can choose a parabolic SAR, which could be, I'm going to use the blue color, or let's choose another color that could be more clear. Okay, so here we can use the moving average in order to filter the trend, and we can look for any breakups in the SAR to the upside in order to buy. So we have here two scenarios to use, similar to what I explained a while ago. It's either to buy any crosses above the SAR to the upside, or you can buy the dips below the SAR as the market is above the moving average. So for example here, I'm gonna just cross this. Okay, so let's take into consideration this move lower. So here you would be either looking to sell these crosses below the SAR, since the moving average is here, so it's signaling a trend down. You are using the moving average for trend filtration, and you are using the parabolic SAR for your entries. So you are selling here again, and selling here. Or you can do something else, which is by selling also any crosses for the price above the SAR, while both of them remain below the moving average. For example, you're selling this, and then you're selling this here, and then you're selling here, and again one more time here and here. But this is here. This is what's one of the big uh, risks of this trade. If you are, for example, you sold here, and then another time you sold here, and you didn't close any of your trades, you were expecting a further move lower, and again you sold here, so you have now three positions, and the market crossed above the moving average. Definitely here you had only one candle close, which could be filtered out, so you held the trade and the market moved. But if you were using the moving average as a stop loss, you lost your trades here. So watch out for how much the price is getting far away from the moving average. I'm going to talk about one of the strategies that also can take this into consideration. So watch out how much the price is deviating away from the moving average, and whether the market is extended or not. You can add one of the oscillators, for example the RSI, to check whether the market is oversold in such territories, so you can avoid any entries at the bottom of the market. So this is one of the techniques that you can use on the downside and on the upside, definitely. So if you are setting a trend trading strategy, there is also another trend, another one. It's very simple, just based on moving average and on the price. So you can add a ribbon where you believe that what I'm going to explain is that we all know that the prices move inside a certain moves in waves. So we are either trading like this, or the market is moving like this, and then it goes lower. So all these moves, well, we are reversing from the mean. So this is in the middle, it is the mean, and we are deviating from the mean within a certain extent. So when we are reverting from the mean by diverting from the mean by certain parameters, the moving averages will start to move, and these moving averages will be like an elastic band. This elastic band, when it goes closer, when we press the elastic band and then we remove our fingers, it's gonna go back to its normal shape. Definitely, it is the same when the price is ranging inside a certain area, so it is arranging. So here it is as if we are compressing the elastic band, and then here we remove our finger, and then the market's going to go up, and then the bands are going to go back to getting bigger in shape. It is from this perspective we have this ribbon strategy. So a trader would be looking for a price retracement inside a price retracement inside these moving averages. We have here almost the moving averages from 10 period 10 to period 250. We are using these moving averages because they can show us the price move in a better situation. Definitely we can replace these by just two moving averages, 10 and 250, but also the numbers of moving averages available on the platform, it is visually easier to us to detect how the price is moving. So here it is definitely easier to detect that the market is retracing, since the moving averages are compressing at each other. And then when the market moved again away from the moving averages, we are going for another leg lower. So we have here a retracement, the market moved lower, we have a retracement, and then we're moving down back. So this is what we can have in theories. For example, this is what we definitely see in trends. The market is moving like this. So by this way, we were able to detect these retracements here. So we detected how much the prices rebounded or retraced inside this ribbon of moving averages, and then on the breakout, a trader would be selling a new position. So either we would be selling here, so we would be taking some trades here at these retracements, or some traders would be looking for any break below the previous low, similar to what happened here. So these couple of moving averages, they are very easy to use. It is just a couple of moving averages. We are using them together in order to make it easier for us to see the recent price move or the recent fluctuation in prices. Here we can see how much the moving averages are compressed to each other. The distance between the different moving averages is closing in. This is showing us that the market is not volatile anymore and it's losing its volatility. So this will raise the chance of a breakout. So when we see the moving averages are closer to each other and they are compressing at each other, this could signal that the market is close to breaking out either higher or lower. So that's why here we have to do our fundamental analysis in order to to have a bias or to have more knowledge whether the market is capable to move on the upside or on the downside. So these are the moving averages, how to use them. We can also use them on the different scale. Also, you can look at when the moving averages are extremely wide away or far away from each other, so you can estimate that the market is overbought or oversold, and you should start be looking for reversals similar to what happened here and similar to what happened here, and we witnessed this retracement of around 38.2%. So this also could help us to trade reversal to the mean. So this is one of the easiest strategies to use by just applying a couple of moving averages and make it easier for us to see how the price is moving. So these are the strategies that I wanted to talk about today. They are very simple and straightforward. And now Sai will talk about the pillars of a trading strategy. And in the end, we'll have a question and answers session, and we will be answering all your questions. Sai?
Right. Thank you, Weil. Hello, everyone. I think everyone keeping well. It was a very short discussions and presentation by Weil about the trade range trend and as well as range strategy. So let's move on to the next, which is correlated to this strategy. So majorly like any traders were looking for type of systematic things. So here what we're going to see here today is like the pillars, the important pillars for the trading strategy. One, to want to be a real trader or want to be a success trader in the trading history. So we are kept a four major type of pillars. That's one which start with the logical trading strategy. Like today we seen some couple of strategy which Weil was explaining. It's one of the strategy which was clear cut indication information was here. So that's what about the trading strategy. Next, the pillar is like risk management plan. The most important thing in any live trading atmosphere. So it's the most important, like we have to know what the risk you have been taking in the what plan you have been implementing and how you're going go forward for the long-term trading plan. Journaling, and the last pillar is like it's a sound philosophy, psychology, sorry for that. So these four pillars are the major important factors, or you can say more important points to be considered want to become a successful trader. So let's go on look into one by one, which is already we have discussed in many webinar individually about the trading strategy, many type of trading strategy, and we discussed about the risk management. We discussed about the psychological, like what type of psychological factors are there in the trader's mind, how to overcome these all the factors are there. So let's say a throwback here, just you want to, since we are covering a strategy or we coming up with important type of strategy, so you want to come along with this type of information to share to all our listeners, to have a strong knowledge and to be protected from their risk, and as well as want to be on the markets. So logic trading strategy. So the trading strategy refers to the methodology or strategy or a plan that the traders use to make money in the markets. Even in our webinar, in a weekly based webinar, we have discussed many trading strategy. We have made up what created many trading plans, and we have discussed many trading systems, how exactly you can use it off. So basically, the trading strategy is nothing but a initial stage of the pillars. Like, you want to make a pillar. This is the first stage of the step to be carried forward. That so major thing is like you have to identify the trade setups. That means as you are a technical trader, basically, like if you are purely a technical analyst and you want to be on a technical trader, as you know, there are different type of traders. They are like fundamental traders or technical traders. So when I'm talking about the technical traders, we need to be very set up the initial stage, like, okay, what have to do, which indicator has to be followed. So like you can select the indicators like oscillators or any technical tools to choose his strategy, to set up his strategy. So that's the first most things to be carried forward, to be look into that whenever you want to start a trade. To what to trade, when to trade. So that means choosing the products, which product you choose you for your risk management. That means if you're more familiar, you're more aggressive or more interest on particular currencies, because there are a lot of products available with ICMs, like a lot of instruments to be traded with ICMs. You can take it for currencies or commodities or energies products, even in indexes, or maybe talking about the stock markets, your stock markets. So we can choose which one you choose for you, which one we can follow, because as I said, like factors are various types are there in the markets. Even can move in different directions and depend on different factors. It can move on different like technical factors. Sometimes market moves on the range, or talking about the trend, whatever may be. So choosing the product or choosing the instrument, it's a more major things, because some traders that get confused, they keep trading on a different product like choose for euro, they come into the currency, then they see that some losses, they are quite not comfortable with the trading, they see many losses are there, then jump into the commodities, then later they are trying to understand something and they get into the other product like energies. It's not like that. It's you have to choose a product, which one you want like to trade. So when to trade, that means depends. There are many type of traders are there in the markets. Like there are maybe some traders do for hobby, like they want to trade for hobbies, like they want to just do some buy and selling whenever they get time. Some traders are there or like a job, like they treat their trade like a job, like they want to be in a professional, want to keep stick as a time, so they stick on a time. Like for example, they are already a full-time job, or they want to do a business at part-time trading time, they fix a timing about it. Usually market has more volatility when there is US market starts. That's everyone knows about it, because at different round the clock the markets keep on running to all the 24 hours. So other traders are there which they are like a business, they treat like a business. That means they are full-time traders, they are like full-time job trading platforms, like you sit in the markets full-time. So choosing out the timing is also very important. Apart from this, parallelly, what time you'll be trading, whether I'll be trading on a volatile markets or I'll be trading on a range time markets. So depend on your risk factors, So this strategy also is a correlated with the risk, which we are going to talk about the next pillar of this of the success of the trades, which also correlated. So it's not mean with only the strategy we can't success in the trading. We have to go with a combination of your plan to be success. So you need to go with all other information. Time frame to be used, as you know, like very important point, because we have been discussing in a platform, and while was showing many times in a 24 platform that yeah, different time frames are there in the markets. For example, some traders will be able to choose 1 hour chart, sometimes they choose 4 hours. Some traders like to go for a daily chart, or maybe weekly or monthly, depending on what type of traders, because there are day traders are there, yeah, push-in traders are there, intraday traders are there. So depend on your trading style, depend on your time availability, or depend on what type of trader you are. So basically you choose the time frames. That's the most important thing. Suppose I am a day trader and I'll choose a 4 hour chart. So it won't suit you for sometimes, because 4 hour chart sits for 4 hours for each candle or each chart to be complete. So obviously it take you for next day, or maybe couple of days, or maybe a week also. So as you're a position trader, for example, you want to be a position trader, suppose I want a long-term trader or mid-term trader, you may choose a 1 hour. No, it won't suit you, because when you say a 1 hour chart or a 30-minute chart trader, basically it's for only for the day trading. Maybe you give a profit or loss or stop loss, whatever, the same day itself. So choosing a time frame, it's also a major important thing. So this all the strategy we are being discussed in many of the previous webinar. one by one. We have discussed like more than 10 to 12 type of trading strategy, including today. You can have a look on. So this is one of the major pillar of success on a trading. So let's move on to the next one. So it was also a very important point, like a risk management plan. So when talking about risk management, maybe many people are not aware of this. What is risk management? What to do with my money? What I have to do with the money? It's very, very important. It's like a two eyes. Like one is a strategy, one is a management. It's like a two eyes. So money management is one of the key concept to a long-term success in the financial markets. That's most important thing. Even an individual or maybe an institutional or maybe a big investors who always have to follow the risk management systems properly. 100% has to be followed. Unless that done, you can't be able to success in trading. So basically, this manage your trading risk. For example, in a previous webinar, we have a separately took a separate management risk, money management topic, which we covered about risk to reward ratio method, percentage risk method. Like we are talking about the leverage, how to use the leverage, how to scaling your positions, how to add your positions. This is all information we already added. We have discussed many things. If you have more specific information, you need more elaborate information, always we can have a look on that. Basically, this management is basically talking about the success in trading comes from the right management. That means your stop loss, your trading the stop loss, what amount of margin to be used in your trading, what type of trading strategy you're following. And in such cases, what is the loss you are being able to occurring? What is the risk ratio for that? What is the percentage of risk you're going to take? For example, each and every trade, what is my risk? For example, I'm ready to take 2% risk of my each trade. Okay, I'm ready to take 5% or maybe 10%. So depend on your margin. So in such cases, sometimes you can able to scaling your risk. That means averaging your position. For example, when you are while I was explaining today like about the ranging markets, you can able to average your position by adding when the market is coming down. So even market is crashed, you will protect your entire equity. So this way exactly the plan should be. The risk management to protect your financial situation, to protect your equity from your trading loss to be burst. So this is very important. So each and every plan should be managed or maybe traded on each and every lot should be traded on a different level of percent of risk. So this all covers with that. So risk management basically as a very important topic, even it's to be must to be followed by each and every trader. How the trade will be executed, which each trade will be executed, what are the margin have to use. For example, if you are a trader as a range trader, if you want to be on a range trading, obviously you have to be have enough money to be average your position. For example, in case of range markets, so there will be a slight ups and downs will be there. For example, you're a buyer in the markets and you're expecting market to go up to appreciate, but unfortunately markets keep coming down in a different range of consolidation. So you need to average your position. So you have to be very prepared or depend on your equity, depend on size of your amount. Okay, how much I should average my position. For example, you had it from 5 lot in initially and you like to take a 5 lot. No, you have to reduce the lot size, because when the risks keep coming out in a different outside directions, definitely you have to take a more risk on the markets. So when the market moves against you and you are accumulating a lot of positions on the downside, obviously there's a big risk accumulating on your account. So this all to be considered, and this one of the best important and very, very, very carefully to take care of this risk management. Each of trader has a own risk management system, because it depends on your capacity of risk, depend on what type of trader you are, depend on what type of trader you strategy you are following up, and what type of risk you can take it on your entire financial situation. So this all depends on every individual. So it's like that. So this is also one of the important pillar which you are going to be want to be followed to be a great success. Let's move on to the next, which is journaling. Mostly, I don't know how many traders have been following this journal. Normally, we do follow on daily basis as a human being. We normally as type of things, what we made today. Okay, how much I made today. Fine, everything is good. Or okay, I'm checking out the trade every day. Like, well, I made today like this much money. I lost this much money. Okay, let's move on to the next. No, fine. It's good that you are having a track, but journaling, it's also the same way, but it's not like following on a daily basis. You have to follow on in a combine. For example, a trading journal is a complete record of all your trading activity over time. For example, you choose some strategy today and you try to follow some strategy. As I said that many times we have been discussing, never tried any strategy on a demo account, because it's just a demo which never give you a seriousness or it never gives you a perfect lesson. We won't be learning out of it. So always try on a live account atmosphere. It can be any type of amount, like it's not be should be the this much money. You can try anything with a small strategy, whichever is comfortable for you. So when you have a trading strategy, you need to find out this trading strategy, it's going good or bad, whether my strategy is giving a performance is good or not. So definitely you need to have a look, a background look, or maybe a background check or a report check on a monthly basis or maybe weekly basis, depending on your strategy timing. You can always have to look on this for exactly your performance. So it helps you to exit a strategy. For example, your strategy is not good, your performance is not good, it's not giving enough percentage of result, and is only giving the loss, or maybe it's giving the excess amount of my risk. For example, you have a $10,000 and you plan to take a risk of 30% risk from your equity. So you have a $3,000. Suppose your strategy is above your $3,000. That means you're losing the money above the 30%. Definitely, somewhere the mistake has happened on a strategy. Maybe you are not strong on risk management, not following the proper strategy. Because I've seen many traders lose. Many reasons is that because they jump the strategy into it. Like, today they follow one strategy. After a couple of days, they follow one thing. And after a week, they follow something. No, any strategy gives a result, definitely good is, unless you follow 100% on a strict disciplined way, as like you are at like in a military way of what I can say, in a military way of action to be on your plan. So this helps you to know what exactly you are doing in the account. So what type of amount or trading you are taking in it. So this strategy help you exit your poor performance. So if you're poor on your strategy, the performance is very poor, you can choose to the next strategy and keep moving out. So it takes some time for it. So in the long run, this will help you one of the most valuable resource, and it will help you to grow your trading business. So this is also one of the third pillars of a trading success. Last and not least, which is a psychology. We have discussed many points and many type of information about psychology, because in a psychology, like, it's nothing but your success or a failure as a trader. It's all depend on the emotions. So as a human being, we all have emotions. You can't say no, we are not a machine, or we're not a computer to listen like a programming 1 + 1 2, not like that. So we have emotion. So you may have a brilliant training system, you maybe have a brilliant trading platform, maybe you have a brilliant trading auto systems, or maybe you have a brilliant robo system, whatever may be. But if you feel arrogant or frightened or maybe upset or maybe fear or greedy, whatever maybe you can say as a psychological point of view, your account is sure to be suffered. That's a very important thing, because one, you should always think that emotion testing is always important, because that's why I said that, like, trading in a demo, it never gives you anything, and trading a live, it will test you. It tests you what you are, what type of person you are, what type of attitude on your trading, because in a real life is different when a trading life is shows a different attitude in the market, in your in personally. So psychology trading, it's manage your emotions, testing your emotions. So when you have a strong trading platform, when you have a strong trading system, when you have a strong trading strategy, never cares anything about the fear, about the emotions, about the any type of things, unless you once you come up. So this is how exactly. So unless you have two platform or two pillars you have properly maintained, properly planned, and properly kept on a trading, psychology is nothing in your front of in the markets. So money gives the many emotions like greed, fear, fluctuations, anger, denial, and so on. Many things. Even sometimes some traders never have food. Sometimes never forget about the food to have, forget about the meal to have it. So this all happens. Many things have come across. Even a small money traders who also feel nothing to worry about it, because you have to keep your plan properly. Unless you not have a proper plan, definitely this psychological effect or psychological impact, which will be there for each and every traders in each and every trade, especially even a small trade or a big trade. Even some traders never sleep. They have a small size of account in a trading account, but they never sleep into the entire night, because they kept to open the position, because they didn't choose which type they are want to trade. Suppose you want to be a trader for 1 hour or 30 minutes, but unfortunately, since you don't have a plan, you randomly taken to jump into the markets and he took some position, and unfortunately market is against him. It took the day trade to the next day, so next day to the second day to the third day. So what happened? As a day trader, he became as a position trader. So there the mistake starts, because he didn't keep his target, He didn't keep his stop loss. You don't have any plan with him. So what happened? The fear comes, the emotion comes here, and mostly like it get fear about the markets. You worried about the markets. So when you trade, like, and you start doing speculations, or buy here, sell here, buy here, sell here. So it's completely, it become a type of a fear comes into it. So it's like that. Strict money management. This is the best weapon to protect yourself against your emotions. So these are the four pillars. So one has to be a success in the trading, have to be followed this, and definitely which will help you to increase in a long-term run in a very good way. And each and every topic we have been discussed in a previous webinar, each briefly we explain what has to be, what is the plan, what is the method we have been following. Everything will be explained on it. I hope you enjoyed. Thank for it. So while.
Yeah, thank you, Sai, so much. So if anyone has any question, please write them down so we can help you. I would just like to remind that all the information, opinions, analysis, news mentioned in this webinar only serve for educational purposes and shouldn't be taken as a signal whether to buy or to sell a certain financial instrument, and ICM doesn't provide any investment advice. The purpose of these webinars are totally educational and informative in order to help you how to take better trading decisions, but definitely not giving you any trade advice.
So there's a gentleman asking question like how I stop myself too much fear and greedy in trading. Uh, Obviously, like maybe I'm not sure whether you are a beginner or advanced trader or experienced trader, or maybe the first stage to be overcome this fear and greedy, that you have to be prepared your a first pillar of trading strategy. So that's the most important thing to be start with. So once you are properly set up with your trading strategy, next move on to the money management. Okay, with that trading strategy, what is the money management to be implement, what to be start with that, what how to plans should be kept on this and money management. When you prepare for this too, automatically it's what happens is overnight. It takes some time to understand, to overcome this fear and greedy, basically. And don't think that when you put your money in the trading, you will make a big money out of it overnight. No, it's not happens in the markets. It's just it's a bubble. So always plan a strategy and make a pure executing plan of management. This two altogether take for a long run, for keep it yourself to test yourself for 1 or 2 months or 3 months, see the result, then definitely it will take it overcome these fears and greedy in the markets.
Thank you, Sai. I just want to also to add one thing from personal experience. So let's say if you wanna, if you are taking the FX trading very serious and you want to have like a gradual income from the FX trading, if you make sure, for example, let's say if you spend $2,000 a month and your trading performance is generating around $2,000 a month too, so you're covering your expenses, you'd be happy. But let's say if you are spending $2,000 a month and your trading is generating only like $500 a month, so you're gonna take more risks in order to reach the 2,000. And this shift in risk that you want to take in order to reach the 2,000 will definitely make you not reliant on your trading strategy, and you will start looking for more entries in order to have more money. So this will weigh all on all your technicalities that you've been following. So make sure always to not look for very high returns or expectations from FX trading. Make sure to have like a gradual return, a small income, and this will help you get more familiar with trading every day and get rid from the fear and the greed factor. There's one approach that I used and it was beneficial back then. Uh, you can make sure to have 1% every day on your trading account, and this 1% it is almost equivalent to 10 pips. And if you have a trading strategy for the 22 days with almost 60 to 70% ratio, it would generate a very good return for you in 1 year. So always have make sure to set a certain target, and this target make it count. Definitely at the beginning it's gonna be so hectic to deal with your emotions, since you're gonna believe that these small returns aren't enough. But when you are having more and more of these small returns, they will be more solid, and you'll have a better also capital, and this capital will, the 1% on the bigger capital will definitely be more than your current capital. So this is also another approach that you can use to get rid of your emotions. Any further questions? Okay, perfect. I would just like to remind you that all the opinions, analysis, news, and information are only for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument. Uh, any one last question before we end this webinar? Okay, perfect. I would just like to remind you that tomorrow we have the Bank of England monetary policy meeting. It's one of the key events this week, and on Friday we have the jobs report from the United States in order to so we can grasp some insight on the latest developments in the labor market following the recent outbreak in the coronavirus in the United States. So also it could have some impact on the market. Make sure to stay tuned and follow all the updates through our channels, ICM at Telegram. So this could be support for you, and thank you for joining today.
Thank you, everyone.